Welcome to The Deep Dive, the show where we cut through the noise and get straight to the insights you need to be truly well-informed. Today, we're plunging into a story that, honestly, just a few short years ago seemed utterly, fantastically impossible. Think back with me to Bitcoin's early days, maybe, say, around 2017 or 2018. It was truly the digital Wild West, wasn't it?
Oh, absolutely. A chaotic, definitely exhilarating, but often perilous playground.
Yeah, populated by cypherpunks, fiercely independent libertarians, and, let's be refreshingly honest, a good many out-and-out gamblers looking for that digital jackpot.
That's a fair assessment.
And the very notion of it ever gracing a serious, button-down investment portfolio managed by a fiduciary or a pension fund, it was, frankly, laughable.
Completely off the table.
You'd probably get a junior analyst snickered right out of a boardroom for even suggesting such a thing. It was an asset class spoken of in those kind of hushed, slightly embarrassed tones, like discussing your rare Beanie Babies collection with a serious art collector.
Or trying to explain the Dutch tulip mania logic.
Yeah, exactly. It was fringe, it was impossibly volatile, and to the establishment it felt utterly toxic, something to be avoided at all costs.
Indeed, it was seen as something that respectable, compliance-bound capital simply wouldn't touch. A fascinating curiosity, maybe, for the tech-savvy.
Right.
But certainly not a cornerstone of a robust, long-term financial strategy. The perceived risks were just overwhelming.
Sam's hacks.
Regulatory uncertainty. The technology itself was largely misunderstood, often dismissed as, speculative, digital magic, or even worse.
A tool for bad actors.
Precise.
But then, something truly extraordinary happened. Something that unfolded with this, tectonic plate-grinding certainty between 2023 and 2025.
A real shift.
Suddenly, the barbarians weren't just the gates. They were invited in, given a seat at the head of the table, and, well, handed the wine list.
That's a good way to put it.
The entire financial landscape shifted, and it shifted dramatically. From deep skepticism to acceptance, and at a breathtaking pace.
It was more than just acceptance, though. It was a fundamental reorientation, I think.
How so?
Well, it was a recognition that this asset, once dismissed as a digital toy or a fleeting fad, now commanded serious attention from the very institutions it was, ironically, originally conceived to disrupt. The power dynamics within global finance were undeniably starting to shift. You could feel it.
And that's our mission today. We're going to unpack this seismic process, what's been termed the institutionalization of Bitcoin.
Right.
This isn't just a simple story of an asset maturing, although it certainly is that to an extent.
No, it's more complex.
It's a complex tale woven with these intricate threads of maybe regulatory capitulation, definitely savvy Wall Street opportunism, and an almost unimaginable tidal wave of capital.
Capital so immense it actually began to reshape the very definition of a legitimate reserve asset in the digital age.
Exactly. So, okay, let's unpack this journey, how Bitcoin went from the margins to the mainstream, and why it's as much about power, politics, and profit as it is about that revolutionary technology.
We'll explore how the gears of power in Washington, D.C. finally ground into a new, more accommodating position that really cleared the regulatory fog that had shrouded the space for years.
Which let the traditional financial world engage.
Yeah. Then we'll dive into how the world's largest asset managers managed to turn what was once this digital curiosity into a must-have portfolio component, making it accessible to millions.
And finally, we'll trace that unprecedented cascade of corporate, institutional, and even sovereign money that followed, fundamentally altering Bitcoin's standing and, well, influencing its future trajectory.
It's quite a story.
Absolutely. It's a progression that, when you look back now, seems almost inevitable, yet at the time, it felt like such an uphill battle at every single turn. Let's start by laying the groundwork. To truly understand this monumental shift, we have to begin at the foundation, the regulatory environment.
Okay.
For the better part of a decade, any serious fiduciary-minded capital, pension funds, large endowments, institutional investors with strict compliance mandates, they were kept firmly on the sidelines.
Didn't touch it.
Held back by one seemingly insurmountable obstacle: regulatory chaos, particularly here in the United States.
Yeah, the U.S. was key.
America's regulators treated the burgeoning crypto world with this potent, almost bewildering cocktail of confusion, contempt, and, in many cases, outright hostility.
It felt like hostility, for sure. They operated what was, in essence, this de facto policy of enforcement by ambush.
Right. Companies trying to innovate in this space were left completely in the dark, guessing at the rules of a game that had simply never been written down.
And when they inevitably guessed wrong, bam, Crippling lawsuits, massive fines, reputational damage.
Sometimes shutting down promising ventures entirely.
That approach created an environment that was just expressly designed to stifle innovation and drive capital away.
Of course.
I mean, imagine trying to build a business, launch a new product, attract serious investment when the rules are constantly shifting. Or worse, only revealed through punitive actions after the fact.
Impossible. It bred paralyzing uncertainty.
You saw firms like Coinbase, right? A publicly traded crypto exchange facing ongoing legal battles with the Securities and Exchange Commission, the SEC, over allegations that certain listed tokens were unregistered securities.
Despite Coinbase asking for clarity, repeatedly.
Exactly. Despite their repeated attempts to seek clear guidance, this kind of regulation by enforcement ensured that any institution with a robust compliance department wouldn't dare touch the asset with a 10-foot pole.
Precisely. And at the heart of this chaos was a seemingly simple, yet profoundly complex legal question. What, legally speaking, is Bitcoin?
The fundamental question.
Is it a security like a share in a company, which would be governed by the SEC, or is it a commodity, like gold, oil, or wheat, falling under the purview of the Commodity Futures Trading Commission, the CFTC?
And that distinction, as you said, it's anything but academic. It has profound implications.
Huge implications.
It dictates which agency holds the regulatory whip hand, what specific rules apply, what disclosures are required, even the types of financial products you can build around it.
And for years, the SEC and CFTC were locked in this very public, often quite acrimonious jurisdictional turf war.
Yeah, each vying for control, which just created this impenetrable fog of uncertainty for institutional investors.
Understandably. No one wanted to invest heavily in an asset that might be reclassified overnight, subjecting them to a whole new set of regulations or, worse, retrospective penalties.
It was a massive impediment, just stopped institutional adoption in its tracks for a long time.
But amidst all this confusion, one agency, the CFTC, had actually maintained a, well, refreshingly straightforward view for quite some time.
They did.
They consistently held that Bitcoin is, in fact, a commodity. What was their reasoning there?
And their reasoning was clear and consistent. Bitcoin doesn't pass what's known as the infamous Howey test.
Ah, the Howey test, the old standard.
Right, the legal yardstick the U.S. Supreme Court established decades ago to determine if something qualifies as an investment contract and therefore a security. A security, according to Howey, involves an investment of money in a common enterprise with an expectation of profits derived primarily from the efforts of others.
Right, the efforts of others part is key.
Exactly. And Bitcoin, as a truly decentralized network with no central management team, no single entity whose efforts drive its value, it simply doesn't fit that mold.
So it's more like a digital raw material.
Pretty much. Like digital gold. Its value derived from network effects, scarcity, utility as a medium of exchange or store of value, not from the ongoing efforts of a specific issuing company.
Okay, so the CFTC's view was clear, which was helpful, but here's the rub. Their power was historically limited, right?
That was the problem. Their jurisdiction was primarily centered on the derivatives markets, things like futures and options contracts based on commodities.
Not the actual Bitcoin itself.
Exactly. Not the underlying cash or spot market where Bitcoin itself is actually bought and sold. This left a gaping hole in the overall regulatory framework for the spot market.
A crucial missing piece for broader institutional participation.
Totally. They could regulate derivatives based on Bitcoin, and they did, but they lacked explicit authority over the direct buying and selling of Bitcoin itself.
That was the crucial missing piece of the puzzle.
And it meant that, for a long time, the largest chunk of the Bitcoin market remained in this kind of regulatory no man's land, further deterring traditional financial players.
And that's where the real game changer came into play. The SEC.
Mm-hmm.
Under its previous leadership, the agency had waged what was widely seen by the crypto industry as this relentless regulation by enforcement campaign, almost a war on crypto itself.
Yeah, the perception was definitely hostility, not just caution.
But then, in 2025, the political winds in Washington suddenly changed direction. That set the stage for a dramatic policy pivot.
Yes, with the new Trump administration taking office, there was a very clear shift in priorities and rhetoric.
How so?
Well, the new administration was keen to be seen as pro-crypto and, crucially, eager to secure American leadership in financial technology on the global stage.
The competition angle.
Exactly. The narrative emanating from Washington shifted dramatically, almost overnight. It went from warnings about inherent risks and the need for stringent enforcement
Which was the old message.
to a vocal emphasis on fostering innovation, repatriating talent and capital, and ensuring America's competitive edge in the rapidly evolving digital asset landscape. It was a complete pivot.
A signal of a new direction for the entire federal government.
It really felt like it.
And this political sea change culminated in a very specific, tangible action. The formation of an agency-wide crypto task force within the SEC, January 21, 2025.
Right. This wasn't just some committee. It was a dedicated, high-priority task force.
And its leadership was absolutely key. Tell us about that.
It was led by Commissioner Hester Pierce, affectionately known as Crypto Mom by many in the industry.
Right, she'd been advocating for clarity for years.
A long time and incredibly vocal advocate for clearer, more forward-looking crypto rules. The task force was explicitly mandated to end that era of ad hoc enforcement. And for the first time, begin writing a comprehensive and clear regulatory framework. The goal was unambiguous lines, viable paths for registration for crypto companies and products.
Sensible disclosure rules?
Exactly. The kind of stuff the market had been desperately demanding for years. This wasn't just talk or another symbolic gesture. This was the concrete signal the institutional world had been waiting for.
Effectively de-risking the regulatory landscape significantly for serious capital.
That was the feeling.
And this new spirit of engagement wasn't confined to just the SEC, which is important to understand. This was part of a coordinated government-wide push.
Yeah, broader than just one agency.
Congress, for its part, began advancing crucial bipartisan legislation, like the Financial Innovation and Technology for the 21st Century Act, thankfully shortened to FIT-21.
FIT-21 was specifically designed to codify the jurisdictions of the SEC and CFTC once and for all, end that long-standing turf war, and create a predictable framework.
Okay, and what was the key provision there?
A key provision proposed that a digital assets network, if certified as sufficiently decentralized, meaning no single company or entity controls it, would firmly place that asset in the commodity category.
So squarely under the CFTC's authority.
Exactly. And crucially, this bill aimed to finally give the CFTC the explicit power over the spot market for these digital commodities that it had long sought.
Closing that gaping regulatory hole.
Yep, bringing clarity to the largest segment of the crypto market. So, exchanges trading spot Bitcoin, for instance, would now clearly fall under CFTC oversight.
So for the first time, you had the White House, Congress, and federal regulators all seemingly rowing in the same direction.
A unified front.
All driven by this strategic desire to establish the United States as the undisputed global hub for digital finance, something that had been conspicuously absent for years.
It was a powerful alignment of political will and economic strategy. However, it's also important to place this American pivot in its broader global context.
Right, because the rest of the world wasn't necessarily on the same page.
No. While the U.S. was hitting the accelerator, major international bodies like the International Monetary Fund, the IMF, and the Bank for International Settlements, the BIS, remained far more cautious.
What were their concerns?
The IMF, for instance, has been openly critical of El Salvador's bold experiment with making Bitcoin legal tender, citing significant risks to financial stability, consumer protection,
Money laundering concerns, too.
and even concerns about potential money laundering or terrorist financing. Yeah.
And the BIS.
The BIS, for its part, has largely focused on the potential systemic risks of the broader crypto ecosystem, though, to their credit, they do acknowledge the underlying technology is here to stay.
And they're exploring concepts like unified ledgers. What exactly are those, and why are they relevant here?
So, unified ledgers are essentially the BIS's vision for how central banks could eventually integrate tokenized assets, things like digital currencies or tokenized versions of real-world assets, into the existing traditional financial system.
Okay, so integrating digital assets into the traditional plumbing.
Exactly. Think of them as next-generation financial infrastructure. Systems designed to seamlessly integrate digital assets, creating a more efficient, real-time, maybe more resilient ecosystem. It's their attempt to harness the technology.
Without embracing the full decentralization of Bitcoin.
Precisely. Without embracing the decentralized, permissionless nature of cryptocurrencies like Bitcoin. So you have this inherent tension. America's relatively new pro-growth push versus the more traditional international focus on stability and risk mitigation.
And that tension defines the global landscape.
But for the world's largest capital markets, especially those looking at massive capital deployment, the direction of travel in the U.S. was, without question, the only one that truly mattered.
The U.S. moving meant the global market could finally move with confidence.
That's right.
So let's be brutally honest about what actually drove this regulatory U-turn, because it's fascinating.
Okay.
The pivot from outright hostility to this new era of harmonization, it wasn't born of some sudden revelation where regulators suddenly saw the genius of Satoshi Nakamoto's white paper, right?
No, not quite a Damascene conversion on the road to Wall Street.
So what was truly behind this dramatic shift?
What's fascinating here is understanding the true drivers. It wasn't a sudden appreciation for decentralized finance or a philosophical embrace of crypto's ideals. It was pure, unadulterated politics combined with a cold, hard economic calculus.
Politics how?
The Trump administration clearly saw crypto as a potent populist issue, something that resonated with a significant portion of the electorate, particularly younger, tech-savvy voters who felt alienated by traditional finance.
Interesting. A wedge issue, maybe?
Political strategists recognized the growing grassroots support and the potential for it to be a wedge issue. More importantly, though, it was recognized as a key battleground in the geopolitical race for technological supremacy.
Right. The competition angle again?
Right.
China's digital yuan, the EU's MiCA framework?
Exactly. There was a palpable fear that America was risking being left in the dust, losing its long-held leadership in financial innovation. The SEC's change of heart wasn't about a newfound philosophical appreciation. It was fundamentally about political expediency and strategic economic positioning.
And that's the cold, hard calculus of global competition, isn't it? With economic blocs like the European Union already rolling out MiCA, creating a clear rulebook across 27 nations.
America risked seeing capital, talent, and innovation flee to more certain and welcoming regulatory shores. We were watching it happen.
Like we were.
Precisely. The sudden flurry of task forces, roundtables, legislative proposals that we saw was a direct response to this competitive threat. Lobbying efforts from major financial institutions, tech companies, crypto firms, they all intensified.
Making the case that without clarity, the U.S. would cede its competitive advantage.
Exactly. Regulators didn't suddenly find religion in the blockchain. They were simply read the new political and economic script, one that emphasized retaining global leadership.
And for institutional investors, the why didn't really matter, did it?
Not really. The underlying motivation was irrelevant. The outcome was everything. It provided the clarity they needed, a clear green light. Less about ideology, far more about that cold, hard calculus of global economic competition.
That certainty was the golden ticket. It transformed a high-risk gamble into a professionally palatable allocation.
That's it.
With the regulatory picture finally clearing, the stage was now set for what many consider the main event. The launch of spot Bitcoin exchange-traded funds, or ETFs, in the United States. January 2024.
A big one.
If that regulatory shift was the key that unlocked the door, then the ETF was truly the vehicle that drove a fleet of armored trucks filled with cash straight through it. This is the moment the floodgates didn't just open, they were blown clean off their hinges.
It's truly hard to overstate how significant this was for institutional adoption. Before the ETF, buying Bitcoin was cumbersome, often intimidating.
Especially for a big institution.
Right. For the average investor, let alone a multi-trillion-dollar pension fund. It involved navigating unfamiliar crypto exchanges, varying levels of security, regulatory oversight,
Grappling with digital wallets, private keys.
understanding self-custody risks. There was this general sense of stepping outside the well-lit, well-regulated world of traditional finance.
It felt foreign.
For a large institution, the operational overhead, the compliance nightmare, the sheer due diligence required to justify direct exposure were simply too high. It was a massive barrier to entry for serious capital.
And that's precisely why the ETF wrapper changed everything. It made an allocation to Bitcoin as simple, as mundane as buying a share in BP or Coca-Cola.
Just another ticker symbol.
Suddenly, you could gain exposure through your existing brokerage accounts using a familiar, regulated, highly liquid product, sitting comfortably alongside all your other traditional holdings.
The very friction that had held back a generation of institutional capital was eliminated overnight.
Making the unpalatable palatable. That's the key.
The convenience factor alone was a revolution. ETFs, by their nature, Simplify everything. They handle custody with regulated partners, provide transparent pricing, allow easy buying and selling on traditional exchanges.
And crucially, they're subject to rigorous regulatory oversight.
Which is vital. It truly democratized access in a way that had been impossible before, opening the door to a flood of new capital.
Here's where it gets really interesting. The launch of BlackRock's iShares Bitcoin Trust, ticker IBIT.
Yeah.
This was nothing short of a watershed moment in financial history. BlackRock isn't just any asset manager, they're the world's largest. Trillions under management, a titan.
The ultimate establishment player.
Their entry wasn't just another product launch, it was a stamp of approval of truly immeasurable significance. It signaled unequivocally that this asset was now legitimate in the eyes of the biggest players. Something previously unthinkable.
And the success of IBIT was staggering, almost immediate. It became one of the fastest growing ETFs ever launched.
Just hoovering up assets.
Literally hoovering them up at a breathtaking pace from its debut in January 2024. Within just a year and a half, by mid-2025, IBIT had already amassed nearly $70 billion in assets under management.
70 billion. In a year and a half.
And put that in perspective, this wasn't just a trickle of retail money. This was a torrent of serious institutional capital flowing in day after day. The speed of its growth outpaced even highly successful established ETFs in traditional asset classes.
And the growth was relentless. The fund's trajectory was fueled by constant aggressive inflows. May 2025 alone saw over $1.5 billion pour into IBIT in just 2 days.
Phenomenal rate for any asset.
This relentless buying pressure allowed IBIT to capture a dominant position, controlling over 54% of the market share among all U.S. spot Bitcoin ETFs by June 2025.
More than half the market.
Which propelled it into the ranks of the top 25 largest ETFs in the world across all asset classes.
Remarkable for a fund based on such a novel asset.
And the demand frequently outstripped the creation of new coins many times over, creating this powerful, undeniable supply shock.
Yeah, there simply wasn't enough new Bitcoin being mined to satisfy the ETF demand at times.
Incredible.
And this wasn't just about making Bitcoin accessible. The ETF fundamentally re-engineered Bitcoin's market structure and its appeal to financial advisors.
How so?
It transformed Bitcoin from what we might call a push asset into a powerful pull asset for the vast and influential financial advisory industry.
Explain that push-pull dynamic.
Okay, so before the ETF, an advisor whose client expressed interest in Bitcoin had to awkwardly push them towards an entirely separate, unfamiliar, often intimidating ecosystem outside their regulated purview.
A compliance nightmare.
And an operational headache. Advisory firms simply couldn't oversee or easily report on such assets held elsewhere.
But the ETF model completely reversed this.
Completely. Now, a product like IBIT could be seamlessly pulled into a client's standard brokerage account, managed and reported on right alongside their existing portfolio of stocks and bonds.
And this is part of BlackRock's strategy, right?
Absolutely, a core part. They explicitly marketed IBIT to advisors as a tool to recapture held-away assets that money clients might have moved to unregulated crypto exchanges and to future-proof their advisory practices against inevitable client interest.
Smart.
And the ability to manage Bitcoin exposure within established institutional platforms like BlackRock's own massive Aladdin system.
Which everyone uses.
Which institutional investors globally rely on for portfolio management and risk analytics. That in itself was a revolution, bringing Bitcoin into the mainstream financial plumbing.
The significance of BlackRock, Fidelity, and their establishment brethren entering the fray cannot be overstated. It wasn't just about the sheer volume of money, though that was a thing.
No, it was the legitimacy they conferred. These are not fly-by-night operations. They are the bedrock of the global financial system, synonymous with trust and stability. Their participation created a powerful network effect, a sort of institutional seal of approval. It gave every wealth manager, every pension fund trustee, every family office the professional air cover they desperately needed to even consider an allocation.
It fundamentally shifted the conversation.
It really did.
And crucially, it inverted the career risk that had plagued the asset for years.
Yeah. Yes, the career risk.
For a decade, a portfolio manager allocating to Bitcoin was taking a massive professional gamble. If it went wrong, reckless fool, chasing fads.
If it went right, just lucky.
Exactly. The ETF, and especially BlackRock's name on it, completely changed that calculus.
Completely. Suddenly, the career risk was in not having an allocation. The question shifted.
From why should I invest
to how can I possibly justify not investing? Think about it. How could a fiduciary justify zero exposure to arguably the best performing asset of the decade?
Especially now, it's accessible via a low-cost, regulated vehicle from the world's most trusted asset manager.
Precisely. This shift in professional perception was arguably as important as the capital inflows themselves. It allowed fund managers to tell their investment committees, their clients.
We're not speculating, we're strategically diversifying with a fully vetted, regulated product.
Exactly. Game changer.
With the regulatory framework firmly in place and the ETF superhighway now open, a multi-stage adoption cycle was triggered, unleashing this new wave of institutional, even sovereign capital.
Right. It wasn't just one big bang.
No, it's what we're calling the Great Allocation, and it's unfolding in three distinct, overlapping waves, starting with a few pioneering corporations.
And expanding towards the very core of the traditional financial system, with nation-states representing that final, potentially most transformative frontier.
Let's talk Wave 1, corporate treasuries. This was led, almost evangelized, by Michael Saylor.
Ah, Saylor. The vanguard indeed. As executive chairman of Strategy, formerly MicroStrategy, he didn't just dip a toe in, he executed a cannonball dive from the highest board.
Fearlessly converting his company's cash reserves and, crucially, raising significant debt and equity specifically to buy Bitcoin.
He developed and relentlessly promoted this new playbook for corporate finance, fundamentally challenging conventional wisdom.
And his playbook was truly unique. He reframed Bitcoin not as a speculative trading instrument or merely currency.
But as digital property.
Yeah, an immortal asset that he argued was technically superior to all traditional stores of value in an era of persistent monetary inflation.
His view was assets like gold, commercial real estate, even government bonds were like melting ice cubes, constantly losing value to inflation and debasement.
Whereas
Bitcoin was a pristine, incorruptible block of digital energy, a perfect antidote to fiat currency's inherent weaknesses. It was a compelling, almost philosophical argument for holding Bitcoin as a primary treasury asset.
and Strategy put its money, and a lot of borrowed money, where its mouth was.
They certainly did. An aggressive accumulation strategy using cash flows, multiple equity offerings, and, controversially, billions in convertible debt specifically to acquire a colossal Bitcoin position.
How much did they end up with?
By mid-2025, the firm had amassed over 580,250 BTC, a hoard valued in the tens of billions of dollars, making it by far the largest corporate holder in the world.
Wow. No longer a niche experiment then.
No, it was a publicly traded case study demonstrating the viability of the corporate treasury thesis at an unprecedented scale, forcing other corporate boards to at least consider the Saylor playbook.
It certainly was bold, and it paid off handsomely for them. But prompts a critical question about replicability. Did this audacious strategy truly set a precedent, or was it a unique outlier?
Well, Saylor's playbook was a masterclass in narrative control and audacious financial engineering, effectively transforming a modest software company into a leveraged bet on a single, highly volatile asset.
Visionary or gambler?
His supporters hail him as a visionary, but it strikes me as a spectacular all-or-nothing gamble that few sane corporate boards would, or indeed should, ever dare to replicate.
Why not?
Traditional financial governance dictates prudence, diversification. Saylor's strategy involved fundamentally altering the nature of MicroStrategy's core business, taking on billions in debt, concentrating extraordinary risk into a single volatile asset.
That's not normal corporate treasury management.
Not at all. While it worked for him, the counter-argument from financial traditionalists was clear. It's one thing to allocate a small, prudent portion of excess cash to a new asset class. It's quite another to fundamentally alter your business and take on massive leverage.
So an outlier strategy, not a blueprint for the average corporation.
I think so. More focused on stable earnings and risk management.
Then came the second, much larger wave of capital, crashing ashore right after the ETFs.
Yep, the so-called smart money.
The hedge funds, sophisticated family offices, major asset managers who had been watching from the safety of the harbor.
The ETFs provided that secure, regulated on-ramp they needed to finally deploy serious capital without the operational headaches or regulatory ambiguity.
And the evidence. 13F filings in 2025 confirmed this wave had truly arrived.
That's right. These filings, disclosing institutional holdings, showed a clear influx. Billionaire-led hedge funds, the titans known for tactical agility, made their move.
Names like
Israel Englander's Millennium Management, Paul Tudor Jones's Tudor Investment Corp., names that carry immense weight on Wall Street, reported to have made significant purchases of Bitcoin ETFs,
So not just speculation anymore, a strategic entry.
validating the asset's entry into mainstream investment strategies.
And this initial foray by these fast movers is setting the stage for what many predict will be a much larger cascade effect of capital.
Right. Major wealth management platforms like Morgan Stanley, Goldman Sachs, after years of extreme caution, offering only limited indirect access.
Now preparing to fully greenlight direct access to Bitcoin ETFs for their vast client bases.
That move alone could unlock a significant portion of that estimated $120 trillion in assets controlled by global institutional investors.
Integrating these products into standard portfolio offerings, it's a staggering amount of potential capital.
And this trend is also backed by hard data, moving beyond just anecdotes. A March 2025 Coinbase survey polled institutional investors.
What did it find?
A staggering 83% plan to increase their crypto allocations over the coming year, citing potential for superior risk-adjusted returns compared to traditional assets.
So it suggests this isn't just a momentary surge, but a strategic reevaluation.
Driven by a growing understanding of Bitcoin's unique properties and that newfound ease of access via ETFs.
But let's not get carried away with romantic notions here, shall we? Because while the hedge funds are indeed entering, their motivations might be different from the long-term ideological holders.
That's a very important point.
The hedge funds weren't suddenly buying into a cypherpunk revolution, were they? There's a more pragmatic explanation. What's your take?
That's right. Let's definitely not get carried away with romantic notions. They weren't suddenly buying into a revolution. They were simply momentum trading.
Explain that.
These are not long-term believers patiently building a new financial system. They are sharp-nosed traders who sniffed out a powerful ETF-driven trend and positioned themselves to profit from the immense inflows that were sure to follow.
So front-running the demand.
Exactly. They recognized the ETFs were bringing in billions in new sticky capital, and they wanted to get ahead of it. They'll use sophisticated derivatives, leverage, complex strategies to amplify returns on short to medium-term price movements.
So their arrival adds liquidity, sophistication maybe.
It certainly does. Adds liquidity and a crucial veneer of sophistication. But let's not mistake it for a deep philosophical commitment to the asset.
They'll be the first to sell when the trend turns.
Without a doubt. Or when their quantitative models signal a shift. Their interest is purely tactical, driven by profit, not ideology.
And then we come to the third and final wave of adoption, only now beginning to form on the distant horizon, but it's the one with the most profound and transformative potential.
Nation-states and sovereign entities.
Right, and this trend moves far beyond the quirky, headline-grabbing experiment of El Salvador, adopting Bitcoin as legal tender back in 2021.
Oh yeah. This is about larger, more strategic players.
The real story here is the emerging geopolitical game theory, forcing larger, strategically minded nations to consider acquiring Bitcoin as a neutral reserve asset.
Exactly. In a world increasingly characterized by de-dollarization trends, persistent fiat currency debasement, heightened geopolitical instability.
The appeal of a non-sovereign, politically neutral, provably scarce asset is growing stronger.
Nations are looking for alternative stores of value that aren't controlled by any single government, especially given the weaponization of traditional finance in recent years. It's a compelling argument from a strategic perspective. Long-term national security.
And we're already seeing forecasts suggesting this is impending. UTXO Management, for example, projects at least 4 new countries and 5 U.S. states will formally add Bitcoin to their strategic reserves by the end of 2026.
And this movement is also being accelerated by domestic policy initiatives, surprisingly, within the United States.
Like what?
Well, proposed U.S. legislation, such as the Conceptual Bitcoin Act, which could mandate a federal acquisition of 1 million BTC,
1 million Bitcoin for the U.S. government.
represents a potential catalyst of immense significance. While still conceptual, the very discussion of such a bill highlights the growing political and economic recognition of Bitcoin.
And if the U.S. did that?
Such a move by the world's largest economy would permanently alter global supply dynamics, lend ultimate legitimacy to Bitcoin as a global reserve asset.
And likely trigger rapid follow-on adoption by other nations, caught in a strategic dilemma, feeling compelled to follow suit.
Lest they be left behind in this new financial landscape, it would be truly monumental if it occurred, effectively placing a government stamp of approval on Bitcoin as a global asset.
That's quite a thought, the U.S. buying 1 million BTC. But how realistic is that for major powers like the United States or China, Given their own national currencies, their established positions, is this really a primary reserve asset for them?
So if we connect this to the bigger picture, sovereign adoption is the ultimate expression of game theory. Nations forced to consider rivals' actions. However, we should be deeply skeptical of the more breathless predictions.
Why skeptical?
While a handful of smaller, maybe dollar-dependent or resource-rich nations might make the leap as a strategic hedge,
Seeking to bypass traditional systems or manage currency volatility.
perhaps. But the idea of a major economic power like the US or China embracing Bitcoin as a primary reserve asset remains, for now, largely in the realm of fantasy. To do so would be an explicit admission that their own currencies, the very source of their global economic and political power, the bedrock of their financial sovereignty, are failing, or at least significantly weakened,
That's a step no major government will take lightly.
if at all. So, while the idea is compelling as a diversification tool, don't hold your breath for the U.S. Treasury to replace its vast gold reserves with Bitcoin just yet,
More likely a very small tactical diversification.
rather than a central reserve currency, yes.
This flood of institutional capital, arriving in these successive overlapping waves, it's fundamentally reshaping the very nature of Bitcoin as an asset.
More than just price.
Exactly. The process of institutionalization isn't just about driving up its price. It's truly about its character, its perception, its fundamental role in a diversified portfolio. It's forcing a complete reevaluation of Bitcoin's long-term value proposition.
And for years, that narrative has been dominated by digital gold.
A powerful, if at times empirically shaky, driver of its adoption.
The thesis is certainly compelling. Absolute, mathematically provable scarcity, fixed supply of 21 million coins, unlike fiat currencies,
Which can be printed endlessly.
and its issuance rate, having approximately every 4 years, famously fell below that of physical gold after the 2024 halving.
Making it, in theory, a superior instrument for preserving wealth against fiat debasement, a compelling inflation hedge.
Sounds perfect on paper, a truly pristine form of money.
But the historical data has often contradicted this neat narrative, hasn't it?
It has.
Bitcoin has exhibited gut-wrenching volatility. Its 90-day volatility measure, often around 70%, a world away from gold's relatively placid 10%.
Huge difference.
And furthermore, its price has often shown a strong positive correlation with high-risk tech stocks, behaving much more like a speculative risk-on asset.
Than a reliable safe haven in times of market stress.
So the digital gold narrative has been more aspirational than actual so far.
This is precisely where the institutionalization process itself may be the catalyst that finally resolves this apparent contradiction, allowing Bitcoin to truly embody that digital gold narrative.
How would that work?
As a larger percentage of Bitcoin's total supply is acquired and held by long-term price-insensitive allocators, think corporate treasuries holding for decades, or large ETF holders with multi-year horizons.
The amount available for trading shrinks.
Exactly. The effective float of actively traded coins available on exchanges will significantly shrink. With less supply readily available for speculative trading, this structural change could, over time, lead to a significant and lasting reduction in its famous volatility.
So, if I'm understanding correctly, as its investor base matures from primarily short-term speculators to long-term institutional holders,
Who aren't constantly buying and selling.
its correlation with risk assets may finally decouple. This could allow it to more consistently exhibit the hedging characteristics its fundamental properties suggest it should have, finally becoming that true digital gold.
That's the hope and the mathematical potential. The supply constraint is absolute, unlike any other major asset.
A massive shift if it happens.
And this influx of institutional capital has also emboldened Wall Street analysts and industry experts to issue increasingly bullish long-term price targets, no longer scoffed at.
What kind of targets are we talking?
Projections for the 2025-2026 timeframe now commonly range from $200,000 to as high as $750,000 or even $1 million per Bitcoin.
Wow. And it's crucial to understand these aren't arbitrary figures plucked from thin air.
No, they're increasingly derived from sophisticated supply and demand models based on projected institutional flows. Analysts are calculating the potential price impact of even a tiny allocation.
Say just 1% to 5%.
From that colossal $120 trillion pool of assets managed by global institutions flowing into an asset with a fixed supply.
And given Bitcoin's perfectly inelastic supply, that fixed cap of 21 million coins.
So such inflows, even if they represent a small percentage of institutional portfolios, would mathematically necessitate a significant upward repricing.
Because unlike traditional assets, supply can increase. No more gold mining, no new stock issuance.
Bitcoin's supply is fixed. The economics of scarcity dictates it. It's not a question of if, but how much, when significant portions of that $120 trillion start flowing in. It's a supply shock unique to Bitcoin.
So, considering everything we've discussed today, the regulatory clarity, the ETF revolution, the waves of institutional capital,
Mm-hmm.
what does this all mean for you? This serious allocator navigating this new reality.
Right, the practical takeaway.
We've identified a few strategic principles that seem particularly prudent in this new landscape. What's the first one?
The first principle is to acknowledge its unique role and size your position accordingly. Approach Bitcoin not merely as currency or a tech stock, but as an emerging global macro asset with truly asymmetric upside potential.
Okay, so what's its primary role in a portfolio?
Primarily, a hedge against monetary inflation, a store of value in an increasingly uncertain world, and a source of potentially non-correlated outsized returns.
And allocation size.
A small, prudently sized allocation, typically in the 1–5% range of a total portfolio, can materially enhance long-term returns without introducing undue risk to the overall portfolio. It's about smart diversification, recognizing its potential to act as the distinct risk-off or growth asset in different cycles.
The second principle, use the right tools for the job.
Yes. And for the vast majority of institutions and individual investors, the most sensible method for gaining exposure now is clearly through those regulated, low-cost, highly liquid spot ETFs.
Why?
They comprehensively solve the critical challenges of custody, security, compliance. They provide exposure via a familiar, efficient wrapper that sits comfortably within a traditional brokerage account.
No need to be a tech wizard, worry about private keys, deal with unfamiliar exchanges anymore.
Simplifies everything for the professional money manager.
And finally, the third principle.
Think in years, not days. Given Bitcoin's inherent volatility, which, as we discussed, may lessen but won't disappear overnight, and the multi-year layered nature of institutional adoption, a long-term holding strategy is paramount.
Forget market timing.
Market timing is a fool's errand in this asset class. The price swings are too unpredictable for consistent short-term trading success. Attempts to trade the violent short-term fluctuations are highly likely to underperform a patient buy-and-hold approach.
Align with the long-term adoption thesis.
Exactly. This is a marathon, not a sprint. Patience will likely be significantly rewarded.
This institutional embrace has undeniably dragged Bitcoin from the digital fringe and placed it squarely in the financial mainstream.
No question.
It has been de-risked, sanitized, made safe for the buttoned-down world of professional money management. The Wild West has been paved over.
A gleaming financial superstore, complete with ATMs and familiar brand names, has been built right on top of it.
Indeed, it's a complete transformation in perception, access, and capital flows.
Absolutely.
But in achieving this widespread mainstream acceptance and becoming a palatable asset for Wall Street, has Bitcoin lost the very soul that made it so revolutionary in the first place?
Big question.
Has the pursuit of institutional legitimacy dulled its edge as a truly decentralized, permissionless, anti-establishment force? That's a question worth pondering as you, the serious allocator, continue to navigate this rapidly evolving financial landscape.